Hi there, and I've been working on this video for a few hours today, and it's a big topic, but it's a very good one, I think. So, client asked me my opinion of a bunch of things, and we can see the questions here. So, I'm going to go through them as quickly as I can and see if we can get this under 10 minutes. So, all right, here goes. First question is is interest rates. What do I think is going to happen on interest rates? Well, there are lots of pundits who know a lot more about this than me. However, based on what I've seen from various pundits that know what they're talking about, they, like macroeconomists, so Lynn Alden is somebody I follow, and Ray Dalio, of course. These people tend to really backstop on economic history, and from there they work out, they look at similar circumstances, and the basic thesis is that people haven't changed much. Given the same circumstances, they behave in the same ways. World War II, lots of government debt around the place. So here we have percentage to GDP, and lots of supply side shortages, lots of reconstruction, just lots of change. And that's exactly what we're going through here. A less intense version of it, but Brexit, COVID supply side issues, economic shocks, high inflation, and preceding low periods of interest rates. We had a crash in 1929, and then there were low interest rates to try and stimulate the economy. But back then there was a lot of government debt. Anyway, where are we at now? Well, it looks like we are in a relatively high high debt environment, relatively speaking. So this is public sector debt to GDP, nearly 100%. It's not dissimilar. Well, it is dissimilar because back in World War II, it was spiking at 250. But what happened was that the GDP goes up, or the GDP number, gross domestic product number, goes up in line with inflation. So in other words, wages increase, and therefore the relative value of debt decreases over time. And that's what I think is going to happen now. We've had a period of low interest rates, and we're going to see a little blip of higher interest rates. And then I feel it's probably going to subside back to lower interest rates, because the economy is a bit of a mess, really. And one way of looking at this is from productivity. So let's get that out. So until productivity really starts to ramp up again, then I think we're going to be in trouble. Now you can see here that after the 2008 crash, there was a dip in productivity, and then it started marching forward. But the general arc, or the general productivity trends, are not like they used to be. So something big has to happen with technology, probably artificial intelligence or whatever, that will drive productivity up again. And with that increased productivity, then you have a renewed economy, which is exactly what happened after World War II. So around 1950, 1952, the economy had reformed, rationing had finished, and the economy was rebuilt, and therefore interest rates rose, inflation was low, and good times came through until around 1970. Now, the story with 1970, of course, was baby boomers. There was a huge spike in population after the war, and then you had this cohort who were buying up resources. So there was houses and other such. So there was a massive demand side inflationary period in the 70s, but there was low government debt, so therefore, and low private debt, and therefore it was possible, and you can see it here, it was possible to then jack up interest rates without causing too much damage. But that's not the case today. There's so much private debt, so much government debt, that it would be catastrophic for the government to jack up interest rates too much. And how do we know that? Because we look at the house price. And here is private sector debt to GDP. And you can see in the 90s, it was relatively low at 150% thereabouts, and now we're at 180%. But you can see around 2000 peak 2008 when everything just went crazy, it was nearly 240% to GDP. But nevertheless, there's still relatively high ratio of debt. But it's manageable, but it's not crazy. But the point is that if the government raises interest rates too much, that's going to cause some serious problems with the economy. It'll slow it right down, and governments want to stay in power, and the way they do that is they get people to continue voting for them, hence the importance of the economy. So, all right, getting back to the next question. The recession, yes, but the reality is that there's huge rental demand. Now, I have some data on this, but broadly, in good areas with a decent local economy, properties will rent out in under a month. There are some places where demand is lower, obviously, so impoverished areas where it's economically very difficult, say Tyneside, Hull, Blackpool, these kind of places. But overall, there is about half the supply of rented accommodation than there was in 2017 because of the government changes in tax, where if you own a property in your name and you're a higher rate taxpayer, then you can't offset the cost of interest against mortgage repayments, and therefore you get absolutely smashed for tax. And so these people just simply sold these properties back into the market, and that was that. So anyway, I'm confident that rental demand will continue, and that because there's such a massive housing shortage, that there will still be demand holding up the market because there are enough people who can buy with cash or lower loan to value. And I see rents kind of carrying on in line with inflation because rent, if I get another chart. Yeah, and this is the ratio of house prices to rental income. It varies depending on the area you're in the UK, but the upshot is that a lot of people will simply just give up on buying a house and they're going to rent instead, and then they will put their disposable income into just living for now. And that's the way I see it. So prices holding up. Rent will go up in line with inflation because rent is simply a day-to-day cost of living. And that's why I think the rental market will hold out. And also what I think will happen is people will trade down. So where they would have gone for a slightly flashier place, they'll go down a level. So as a landlord, what you're after are nice houses that nice people want to live in. And you want to make sure, obviously, that they are economically robust. So they've got plenty of disposable income, they've got good jobs, and they see your property as a lovely place to live for a while till they sort themselves out and buy their house or whatever they do. But the reality is they may never buy that house. The next question is, what would I do for the next year? Well, I'm pretty confident that we'll know what's going on after the November Bank of England meeting as to whether they're going to raise interest rates or not. And I think by then, so we've got another 3 weeks to wait, I think it is. And then we'll know roughly what's going on. And in the meantime, what I'm seeing in the market is that good properties are still going for a good price. That if it was me, I would buy with cash and look at refinancing later. And I would go for vacant possession or quick turnaround on completion, simply because I would want to get my cash employed as soon as possible. And there's a very simple reason for that, and that is inflation. If we look at the current inflation rate and interest rates, so this takes us into a big topic, which I won't get into too much, but essentially, if inflation is high and interest rates are medium, but there's a gap between inflation and interest rates, then the way that works is that if you have money on fixed interest rates and inflation is higher than the cost of interest, then over time you're eroding the real value of the debt that you have. So in other words, if you have 5% interest rates and you've got a mortgage for 5 years at 5%, then cumulatively it's whatever it is, I'll call it 25% for round numbers, then it's £100,000 debt, then in theory you've spent £25,000, that's £125,000 in debt. So you've got to repay the money back at some point, assuming. So principal plus interest, 125. However, if inflation is running at say 8% annualized, then let's say it's 5/8 of 40%. So let's say in 5 years' time we've had 40% inflation, which is not unreasonable considering the circumstances. Then the value of that debt is eroded by £40,000 in real terms, and then you've got a gap between the £40,000, the £25,000, which is £15,000, and thus you are in real terms £15,000 up. So it's a big concept, and there's a lot of moving parts to all of this, and I've done a video on it which goes into it in some depth. It's quite involved, but the point is I've done the calcs, and the upshot is that if you get money at a reasonable price, it looks like you will get a 10% return on investment when you factor in all these variables, like rent goes up in line with inflation, interest rates are fixed, and inflation erodes the value of money. And depending on how you look at it, then you're in a good place. There are broadly two ways of looking at it. It's the cost of debt relative to your income being rent. It'll get better and better over time. And the other one is the debt relative to the value of your property. And the likelihood is that it'll go sideways for a long time. So that's not so good, but there will be a period where it starts picking up again, because markets work in cycles, and they have done for the last 170 years. So therefore, I'm very confident that the market will just keep chugging along and will pick up over time, as you see here. So property market, that is. And therefore, when the market's on the run up, your return on investment goes exponential. So then you're looking at 15% to 20%. If you factor in net cash return plus capital growth plus erosion of value of money, then you're definitely in the kind of 20% ROI number. But there are a lot of moving parts to these calculations, and you have to kind of understand your spreadsheets and your numbers to be able to work all this out. And for most people, what they do is they just say, well, am I going to be cash flow positive? Is it a decent house? That's all they want to think about. And if that's good, then they're in. But if you're more sophisticated and you actually start to look at all the permutations, you realize that actually this landlording game is amazingly lucrative if you buy the right property in the right area. So that's my kind of general answer to these questions. And I suppose the other question, the final one, is what about just putting it into a passive income thing? Well, yeah, you could do, but then you don't get the return on investment. You get the safety, but then you get safety when you understand what you're doing, because you know what a good investment, property investment, looks like versus a bad one. So thus, property becomes safe to you as a knowledgeable investor. If you don't have a clue about property and you buy some dreadful property in some terribly deprived area in Hull or someplace, well then yeah, it's dangerous. But for our clients, they buy sensibly and they get a safe investment. So in my view, the return on investment is so much greater when you aggregate all these variables than if you put it into a gilt or some bond or something like that. And that's why I would not do that. I would not put money into the bank and just get interest out of it. I just think that would be a huge waste of opportunity when actually there are some huge opportunities coming along. So the kind of properties that I would go for in terms of yield, as I think I talked about, I've done a few takes on this, so sorry if I'm repeating. For the lower end of the market, the £120,000 mark, you would be looking at, say, 6 to 6.5% gross rentable yield. For mid-price, 5.8 to 6.2, that being 150, 180,000. And above 180,000, say 180,000 to 220, you're looking at, say, 5.2 5.6 to 5.9, 5.5 to 5.8, that kind of thing. So it's cost of purchase, cost of the actual property plus the renovation, making it rentable, gross rentable yield. And what I'm seeing is, I'm not seeing desperate sellers. I'm seeing people who are willing to actually just listen. And I'm seeing our investors having a real chance of buying properties, nice properties. And really, that's the game. I think it's delusional to think that you can just pick up a dirt cheap bargain. Maybe, but I think you have to look very hard for those. And they're not easy to find, and generally they have serious compromises. So what I would always do in these kind of circumstances is just buy the property with no real compromises, that's really up together, and buy for quality, because in the years to come, those quality properties will do really well as capital growth returns to the markets. So that's roughly it. I hope that's helpful. It's a huge topic, as you can see. But anyway, there we are. Thank you very much.